discussing about EBITDA margin, that is earnings before interest, tax, depreciation and amortization. Now I don't like what that is nothing but sales minus COGS is gross profit less operating, administration and selling expenses. If we deduct, we get operating profit, correct? Operating profit is also called as PBIT or EBIT. So in this you have EBIT. Need not worry about that EBIT. This is what it is, correct? But still what they are doing is they are asking you to find out the margin before taking these two non-cash expense into consideration. That means we are not deducting these two. Fine. If I see this is operating profit or earnings after like earnings before interest and tax, correct? Then next what we have to do is if we deduct depreciation and amortization, let's say the profit, the next resultant profit becomes earnings before interest and tax after depreciation and amortization, correct or wrong? See, this is EBIT. From EBIT, if I deduct these two expenses, the profit, resultant profit would still be EBIT, but EBIT after depreciation and amortization. Please tell me yes or no.
Mm-hmm. Yeah.
Correct, correct.
Yes.
But like, why are we doing this? See, EBITDA stands for earning before interest, tax, depreciation, amortization. Like EBIT, which is earning before interest and tax, includes deductions from depreciation and amortization expense. That means when you are getting this, already in operating, administration and selling expenses, you have already deducted your depreciation and amortization, correct? Operating, administration and selling expenses. See, depreciation of plant and machinery goes in COGS also as a part of manufacturing overhead, correct?
Yes.
Correct? So, depreciation and amortization of any intangible assets would go in operating expenses. So, these two you have already deducted and you have found out your EBIT. But we are saying that if you think that you have not deducted this, okay, this profit is what? Earning before interest and tax after depreciation and amortization. But if I say if you don't deduct these two, you'll get still EBITDA, correct? You'll get that. If you don't deduct, you get this. If you deduct, you get EBIT. Now, therefore, EBITDA is EBIT plus depreciation and amortization expense. That means what you have deducted already, I'll write it here. EBITDA is nothing but EBIT plus depreciation plus amortization. This, what you are doing is already you have deducted your depreciation and amortization to get this, but you want to go into this, correct? So what you have already deducted, you'll add to EBIT to get EBITDA, correct or wrong? Please tell me. Yes, yes, of course. Now, so we are adding back depreciation and amortization, which we have already deducted to find EBIT. So if we add this, we get EBITDA. Why are we taking this? It is used to analyze a company's earnings before interest and taxes as well as before the non-cash charges of depreciation and amortization. That means the reason or agenda of taking EBITDA is nothing but we are taking earning before interest and tax and also before non-cash expenses. What is that? What is that? Non-cash charges. Yes. See, these are two expenses. But practically, if you see, there is no outflow of cash from these two expenses. Okay. Do you think depreciation is what you're paying from your pocket and amortization is what you're paying from your pocket?
No,
Do you
no.
think? Never. So what we are doing is we are taking that earning which is before the non-operating expense, which is interest, as well as non-cash expense, which is depreciation and amortization. It is also one of the ways of assessing the performance of the company. Okay. Did you understand? Did you follow?
Yes, somewhat.
See, EBIT is nothing but earning before interest and tax. Interest is non-operating expense. If I take DA also, it is non-cash expense. So we are taking earning which is before non-operating and non-cash expense, okay, and then we are trying to see what is the like profitability we are getting from this particular profit figure, okay. In actuality, this particular ratio is of not of that usage, not given that importance, because you are taking all the expenses, you are taking such earning before deducting all these expenses, correct? Fine. Okay, what matters
Yeah.
to us is EBIT, that is operating profit, EBT, EAT, that is earning after tax. This is what it matters to us. But and what this is operating profit, this is net profit and gross profit. These three things matter to us, but not this. But still, some analysts take this as a like a source of this particular data to find out the company's performance. Okay. Company's performance on what basis? They are taking earning before non-operating and non-cash expenses. So what is the profitability of the company before these kind of expenses deducted? That is what they are going to see. And one more thing very clearly mentioned, it is not a GAAP, it's a non-GAAP measure. That means as per US GAAP, you generally don't take this. Okay?
Okay.
Because depreciation and amortization is however happening. How come you can ignore these two kind of expenses and check? It is not going to, it's not like going to be a good measure. Okay, that means legitimate profitability is what you are not seeing. It is not a legitimate profitability measure. It's illegitimate profitability measure. Why? Because you can't ignore all the expenses. What matters at the end of the day is net profit. Correct. So only three types of profits are applicable and important: gross profit, operating profit, and net profit, but not EBITDA. But still, some of the analysts, they use this. It's not a gap measure. As per US gap, this is not followed. But you cannot ignore the fact that in the entire world, US gap is not the only standard which is used. Some of the companies or some of the countries, they follow IFRS. Some of the countries, they follow their own local accounting standards. So they may be taking this measure. Okay. And why it is not being considered is it is very easy to manipulate this one. See, when interest, taxes, depreciation and amortization are factored out, that means you're not taking, a firm that is actually operating unprofitably may appear to be profitable. Why? Because you are trying to ignore some of the crucial expenses, correct? When you're not taking these four types of expenses, then what are you deducting from your profits? Ultimately, you will be profitable. Isn't it so? Please tell me yes or no.
Yeah.
Yes or no? Yes.
Yeah.
If you are going on ignoring expenses and not deducting them from the gross profit or operating profits, then what are you doing is ultimately you are manipulating. That means you are hiding your expenses. Hiding expenses are nothing but ultimately trying to show more profits. That's all. Now I would like you to take this screenshot of this. Please take screenshot of this. You have to do this at home, or you want to do right now. Will you try this?
Yes, sir. We will.
Yeah, please try right now. The data is an analyst is reviewing the financial statements of a company whose operating income has declined from the prior year. This is prior year, this is current year. You can see the gross profit margin has come down, operating profit margin has come down, inventory turnover has gone down. Based on the above, the analyst could infer that decrease in the operating income may be due to what? Due to lower revenue per unit sold. That means per unit, whatever you are selling, you have decreased your selling price, accumulation of unused inventory, higher interest expense, increase in advertising expense. What can be the reason for your decrease in operating income? Come on, tell me.
Higher interest and increasing advertising expenses.
Sorry.
D.
D. On what basis? If it is D, then why?
We can increase the advertising expenses now. For that, the operating income will decrease.
If you
Accumulation.
no, if you increase your advertisement expenses, of course your operating income may decrease. That fact is correct. What about the other facts then? What are they saying?
This accumulation of unused inventory.
See, accumulation of unused inventory. See, the operating gross profit is nothing but when you remove sales minus COGS, and then you get this, and then operating, administration, selling expenses. If you remove, you get operating profit. So lower revenue per unit sold. If you are lowering your revenue per unit, your gross profit would also decrease, na?
Yes.
Correct?
It's getting lower. Prior year is lower. No?
Yeah, but no, sorry, it is increasing. But sorry, 60%. See, if you are charging $10 per unit, and if you are like charging $5 per unit now, your gross profit should decrease, correct? But what is happening here? Gross profit is
Increase.
20% increase.
increasing then. Okay, if at all unused inventory is more, so COGS when you calculate, okay, so if at all like I bought some 100 boxes, I'm selling 80 out of that, so like bought it for $10, selling it for 12, and like revenue 960, COGS opening inventory I have nil, purchases 100 minus closing inventory, 100 into 10 minus 20 is my closing inventory, correct, into 10. So uh, like 200 if I remove, I am left over with 800. Let's say if it is 300, then I am left over with 700, correct? Isn't it
Yeah.
so? So with this closing inventory, if I deduct more, my cost would what?
Decrease.
Increase.
Decrease, na? How increase? I am selling less right now. Then I have to like
960.
I have to see
Yes.
here also. Then here also I need to do the adjustment. Here also I need to take revenue as per 70. Then I cannot take as per 80. Am I right?
Okay.
Correct. But decrease, see, interest expense is not at all a matter here. It is a non-operating nature expense. It will come after operating profits only.
Yes.
But if your advertisement expense is increasing, of course your operating income would decrease. Okay, and that can be the answer. Your answers are backside of the book. Option is D, correct?
Yes.
Reason are also given. So like you can go through this. Fine. Just see the reason. They have given the reason, please. Just read out. We'll go for the next one.
So this one, are you referring to the textbook, Hopwala textbook?
Yeah, Hawk textbook, but the thing is like you have new textbooks. This is old textbook.
Ah, that's what. It's not
New textbooks have
similar.
no questions. Old textbooks have questions between. I'll share the old textbook with you
Yeah,
for this
better.
questions. Yeah.
In the new textbook, why they don't give the sums?
Don't know, madam, what is their problem? Why they
There
do
are
that?
no sums.
During
There is no
complex.
practice.
Yes,
Yeah,
yes.
very.
When there is
It's
no
very
sums, we
strange
cannot
from their
practice.
part. Very strange,
Is
of
there any
course.
other textbook for the practice purpose?
Yeah, I have this one. Now, old textbook has lot many questions in between. I'll share this book.
Yeah. For the new version, is there any other another textbook for the practice purpose?
It is there, madam. I'm like kind of ordering that. I'm trying to get the latest version. We'll get it soon. We'll share.
Okay.
So you will give us the textbook, sir, the old version.
Yeah, yeah. I'll send the mail to you. Of course, today
Okay.
itself. And that PDF also I need to share, no? About the
Yeah,
problem.
yeah.
2 minutes. I'm giving a WhatsApp right
What the happened? Our revenue. Balance sheet.
Yes, sir. Done.
now. Yeah, just a second. I'm sending the PDF. to you.
Could you scroll bit up, sir?
Yeah. I've sent it. Just can you open? Can you find the liquidity and all those ratios?
Give me a moment.
Can you? Because it's not getting open. Okay, just a second.
Have you WhatsApp, sir?
No, I'm just like doing on Skype and also I have WhatsApp. Yes. Just give me a second. Just a second. Yeah.
Word we have.
Sorry. Hello.
Yeah, hello. We are trying to open the file, no?
Yeah, I'm just seeing like where it's not opening now.
Adopt. Can you click on adopt?
Yeah, I'm just seeing.
Open with adopt.
So here you have all these ratios, okay? Like you have, you can see the first one, profitability, fine. Profitability per share, profitability, such kind of you are seeing like return on assets is they're asking like profit margin on, like they're asking something, target price to obtain. Okay, that's a general question. Gross profit ratio, net return on assets they're asking. Like this, some questions are given, return on assets, return on equity, profit margin. Okay, so you can try some 10 questions at home. Okay, or else for the timing, if you want, we can solve in the class. That's not a problem at all. We can solve the questions.
Yeah, that's better.
We can solve. Fine, that's not a problem. We'll take up one session for these questions.
So these questions are based on today's session only, sir?
Yeah. Today's and some one or two profitability ratios are all like all the kind of profitability ratios. Okay, all kind of. So I have not finished the concepts yet completely. Once I complete, then I'll explain you the questions regarding profitability ratios.
Okay.
Because right now I have to finish return on assets. Some kind of some ratios are there still to be explained, isn't it? So we have done gross profit margin, operating profit margin, net profit margin, one question, EBI, TDA margin, and what about this? Can you just tell me what the answer for this? Any clue?
A physical count of merchandise in which inventory.
Yeah, according to me, that can be the answer. Why? Because like gross profit margin is decreasing substantially over past 3 years. Cost of merchandise inventory has decreased while sales price have remained the same. If sales price is like you're selling at 100 every year and cost is decreasing, that will give you profits, correct? Higher profits, but not lower profits. So this is a wrong statement, correct or wrong?
Yes, sir.
Ending merchandise inventory is higher than expected. If more in the sense you have to adjust the sales also, that doesn't go. But you are having some physical count you did and some inventory is missing, and that's a loss. That loss can be like every year if it is increasing, that will decrease the gross profit, correct? And our total expenses have nothing to do with COGS. That will come after COGS, after gross profit, operating, non-operating, other type of expenses. Doesn't go well. So what's the answer? C.
Okay. So, while solving this kind of answers, sir, what we have to do? We have to create a problem, sum and solve it, or how can we?
Yeah, you have to analyze. We analyzed the three situations right now, didn't we?
Mm-hmm.
We did the analysis and we gave the answer, no? Did we do
Okay.
that?
Yeah.
So you
So
have to
like
do
that.
analysis. Yes. You have to do analysis and you have to give the answer. So this is the explanation. Please go for that explanation. We'll go for the next question. Have you gone through that?
Yes, sir.
Yeah, that can only be the reason there. Okay.
Yes.
If employees are doing some kind of theft, and inventory is missing, that means it's a loss for you, na? And if it is happening every year and it is increasing, that will decrease the gross profit ratio automatically. Now, next particular ratio is return on assets. See, you have $100,000 worth of assets. Okay. With assets, what are you going to do? You are going to use your assets to run your business for production purpose or for any other purpose. You buy assets for what? For doing business. Correct? Yes or no?
Yeah.
With these assets, of course, everyone would like to know that I have invested $1. How many cents I am getting from my $1 investment? So suppose $100,000 is the asset value of your business and income what you generated is $10,000. So on $1 of investment in assets, we are earning how many cents of profits? 10 cents. That is the earning, correct? And when compared to previous year $1 gave us 7 cents. That means my revenue, my income was only 70,000. Sorry, 7,000. 7,000. My income was 7,000, but this year my income is 10,000. Not much of the difference has happened to the assets. It's still 1 lakh. So I'm getting more. So this is good, no? Correct? It's like a relative measure. Yeah. And average assets formula is nothing but beginning assets plus ending assets divided by 2. That's the formula for average assets. So you have to see last year when you close the balance sheet, what are the balances? That last year's closing balance becomes this year's opening balance and this year's closing balance. These two balances you have to do average. Then you get average assets and you can put that in the form. Please make a note of this. We'll go for the next one. Any doubts anyone wants to ask regarding this after seeing the example?
No, sir. Can we do some sum on this? A simple sum?
We will do. Surely do that.
Scroll down.
Yeah.
Is that answer?
Yeah. This is what we have already done.
Yes, sir.
Yeah, we already did this.
Yes.
Then now we will, we have right now discussed about this. And now we will discuss about this. Now we are going to do DuPont formula. See, total asset turnover. What do you mean by total asset turnover? See, suppose 1 lakh, suppose 10 lakhs is nothing but the assets what I have in my business, correct? And my revenue what I have generated is 50 lakhs. So what does it mean? With $1 investment in assets, I am able to generate a revenue or turnover of how much?
$5.
$5. Correct?
5 times.
With this, what I mean to say is how efficiently I am utilizing my asset to generate my revenues. So I'll give you a small example. There is a 1000 SFT shop. There is a 10,000 SFT shop. Both are dealing with clothes. They both sell clothes. Okay. So 1000 SFT shop investment is $100,000. 10,000 SFT shop is 10 lakh dollars he has spent for interior and everything, because it's a big shop, small shop. And the revenue what these people are generating is 10 lakhs, and the revenue what these people are generating is 4 lakhs, 40 lakhs. 40 lakhs seems to be a big figure, okay, than 10 lakhs. But here on $1 investment in assets, I'm generating how many dollars of revenue? $10.
And
Here on $1, I'm generating $4. Which is better? This is better, correct?
Yes.
Because this shows, what does it show is this business is doing is using their assets very efficiently and to the maximum extent. With $1 they're able to generate $10 of sales. What they are doing, what not, it's a secondary matter. But on paper and on cards, it seems that these guys are utilizing their assets to the maximum extent. Okay, whatever they can. Okay, shall we move forward now?
yeah,
So so now this also, like when compared to previous year, let's say previous year $1, $5, $1 investment in assets has given me $5 of revenue. This year $1 investment in assets has given me $8 of revenue. So this is a better year. Am I right?
Yes.
yeah,
Anytime. Yeah. So now you also have learned asset turnover. You have also learned return on assets previously, and net profit margin. You already know this, correct? Now what are we doing is, to find out return on assets, you can use this formula also. This is called DuPont formula. What is that?
you want formula.
There's a company called DuPont in High Tech City. You may be knowing or not, I don't know.
Yeah,
Very deep.
yeah.
Yeah, so that is DuPont formula. Okay. So now what does DuPont formula say us is, see, you to start a business, you buy what? Assets. Correct? With assets, what you generate? Revenue. Correct?
Revenue.
Why you generate revenue? To know what are your profits. Correct?
Okay.
When you club, when we take these two, assets and revenue, okay, these two make what ratio? Asset turnover. How?
Yes.
Revenue by total assets. Correct? Correct or wrong? Please tell me.
Yes.
Or sales by total assets. When I take these two, I want to know my profit margin. So what I do here, see, I take this first and this. So I did revenue by total assets, correct? Now here profit by revenue or profit by sales will give me what? Profit by sales will give me net profit margin, correct? Correct or wrong?
Yes.
See, revenue by total assets is giving me asset turnover. Profit by
Yeah,
revenue is giving me net profit margin, correct?
yeah.
So when I take these two ratios and multiply, and I explain the concept also, I'm using my assets to generate revenue. I'm generating revenue for profits. So revenue by total assets is asset turnover. Profit by revenue is net profit
Net
margin.
profit.
So this
Okay.
netting, so net profit margin is net income by sales, and asset turnover is sales by total assets. This and this cancel. Net income by total asset is nothing but
Total assets.
Okay.
return on assets. Correct? Right now we discussed.
Okay.
Please write it down.
Scroll it bit down, sir.
Done? Hello?
Yeah.
Yes, sir. Done.
Okay. So why did you do this question then? Go for this. Say many combinations of net profit margin and total asset turnover will yield the same return on asset as follows. So what they're doing is they have sales and net income. With this, they can find out the net profit margin. They have sales and total asset. With this, they can find out the asset turnover. Correct? When they combine these two, they get return on assets. Isn't it so? Because net profit margin into asset turnover is ROA. Isn't it so? Please tell me.
Yes, sir.
Yeah.
So you are seeing many combinations. Sales is like 50 lakhs, 1 crore, 1 crore. Net income is given to you. Different. Here C's net income is this. And then when you see the total assets of the business, these two have the similar kind of assets, and this is like something which is less. Okay. And then you see the net profit margin also is differing every time. Asset turnover is differing every time. But return on assets is same for all the business. Correct or wrong?
Hmm.
Yes, sir.
That is what is the data given. We can't do anything for that data. Now, disaggregating each company's return on assets into net profit margin and net total asset turnover can help in determining company's strategy to increase returns. Disaggregating is not totaling. Okay, aggregating is total. Now, comparing these three companies' net profit margin and total asset turnover ratios, it can be concluded that company A, if you see the data, you should know, has higher net profit margin, but it could improve its return on assets by improving its total asset turnover ratio. Correct? Why? Because its asset turnover is very less, na?
Yeah. Hmm.
See, they are saying that if they have to improve ROA, see, despite of having a very high net profit margin, still they are having a return on assets which is equivalent to other two companies with less net profit margin. That is due because the asset turnover is less. Come on, please tell me. Hello.
Yeah. Yeah.
If the asset turnover would have been 2, then their return on assets would have been 20. Correct? See, right now
Yeah.
in current scenario, the asset turnover is 1 and the return on assets is 10%. So
Hmm.
what is your like, sorry, not, sorry, net profit margin. Sorry. Net profit margin is 10 and asset turnover is 1. Okay. Okay. Into 1.
Hmm.
This is like net profit margin. This is asset turnover. So if I increase this asset turnover from 1 to 2, what will be a return on assets?
20.
20, correct or wrong?
Hmm.
That's what they are giving a suggestion. If you increase this, your return on assets can increase. If he increases his net profit margin, his return on assets can increase, correct? See,
All right.
yeah, company B can improve return on assets by increasing both net profit margin and total asset turnover. If their net profit margin becomes 7% and their asset turnover becomes 3, then it becomes 21%, correct? So they are
Hmm.
saying that if you make changes to them, you can improve. Then what they have done is with the changes what they have given, they have calculated. Now you can check this and then you can see, like you can understand the concept behind this, what they're trying to say. Come on, go through this. First, go through this entire thing. Now, next one, what they're saying is company C's total asset turnover is quite high. See, asset turnover is very
One.
high, but net profit margin
Yeah.
is very low. If they can increase this from 1 to 2, then 20% can be their return on assets. Correct?
Hmm.
So taking all these changes into consideration, they are calculating something. Please go through this.
Company A has increased its total assets and 1 to 2 increases that due to combination of higher sales and lower efficiency maintaining its net profit margin at -10%
CFP को मत देखो.
increase and discuss all assets and increase profit will thus
Are you going through this?
Yeah.
Okay, so
Can you scroll up, sir? I will take the screenshot of that.
yeah, why not? In fact, I'll send this better to you also.
Yeah.
I'll try to send it. Hey,
Try to understand it. Scroll it down, sir.
yeah. Doing this, Suma?
I have made a note, sir.
Okay.
हो गया सर, डन.
Okay.
नोट कर ली.
Yeah. So this is done, return on equity. Okay. Now we have to learn something else. That is financial leverage ratio or equity multiplier. Correct? What do you mean by financial leverage ratio? First of all, what do you mean by this word called leverage? Any clue? The dictionary meaning of, yeah, anything. Yes, yes.
Yeah, we are giving the leverage like
We are taking leverage actually, taking advantage.
advantage. Yes.
Advantage of what?
Financial.
Debt finance. Debt finance. But why? Because finance has fixed cost, correct? So what is the advantage of fixed cost? The really speaking, the advantage of fixed cost is, see, suppose you pay rent of 10,000 for your premise, okay? And hello, hello.
Yeah, sir.
Yeah, suppose you have a factory and you are paying a factory rent of 10,000. Okay. In this factory, if you make 10 units, okay, 10 units, one unit at the rate of like 500. So what is your what is your revenue in the sense like how much, if like let's say you are making it for 8 rupees and you're selling it for 10 rupees. Sorry, 10 units, I'll write it here. 10 units, it, you made it for 400 rupees, okay, and you're selling it for 500 rupees. Now what is your revenue? Your revenue is how much if you multiply this two?
50,000.
Revenue is
5,000.
5,000, correct?
Hmm.
500 into 10 is 5,000, no?
Mm-hmm.
One unit can be sold for 500, 10 units will be sold for 5,000. Understood fact?
Yeah.
Now my question to you is, given the rent what you are paying and given the revenue what you are generating, are you satisfied? Are you like happy?
No.
You are paying a fixed factory rent, fixed
Hmm.
rent of 10,000, but you are generating only revenue of 5,000. That is
Not
never a
good.
satisfactory. But if I change the scenarios, I change the scenario and I say you are making 1,000 units and each unit is costing you 500. That means you can sell it for 500.
50,000.
Now you
Hmm.
tell me how much? Not 50,000, it will be 5 lakhs.
Hmm. Then we are satisfied.
Very much satisfied. More than what we want. Okay, what we want
Hmm.
more than this? You tell me. What more we want than this? Correct? So 5
Okay.
lakhs is what you're getting. So here, what you're spending is this, and what you're getting is, okay. So it's very good. You are more than satisfied. More than satisfied. So the point what I want to mention here is fixed cost is like something which is like which looks to you a big burden, which looks to you a big burden if your sales or revenue is less, correct? Okay,
Hmm.
you were paying 10,000 current $10,000 rent and you are only generating a revenue of $5,000. But if you are generating a revenue of 5 lakh dollars, this 10,000 rent would look to you as peanuts, correct?
True.
So what are you doing? You can take the advantage or leverage of your fixed cost only when your revenues are
High.
very high. Okay. See, fixed cost has like some side effects also. See, during the COVID days, what did we observe? Whether you were opening your shops or whether you were doing your business or not, you were still paying the rent,
Pay
correct?
the rent.
Variable cost we are not worried about. Why? Because with increase of revenue, the variable cost also would increase. That means if I'm you see I'm coming to office, I'm using AC for 2 hours, my bill will be for 2 hours. Okay. If I'm using the AC for 10 hours, my bill will be for 10 hours. Correct.
Right.
So my
That's true.
variable cost is what would increase with the increase in the activity levels. But even though
Hmm.
I increase my activity level or I don't increase my activity level, whether I do some activity or I don't do activity, whatever it is, my fixed cost is always
Fixed.
constant. So
Hmm.
how I can take advantage of this fixed cost? By increasing my revenue. Why? Because I know I do less activity, I do high activity, I do nothing, I do to the very highest level. Still, I'm going to pay how much? 10,000. Correct?
Yeah.
Did you understand what I'm saying?
Yeah. Yeah.
This is fixed operating cost. Same applies to your fixed finance cost. So when you take debt finance, I'll show you what happens. Let's say there is a company which has got a profit of 1 lakh. Company got a profit of 1 lakh. This is all equity company. This is all debt company. Okay. So this is PBIT. This is also PBIT. Now here there is no interest. The profit is how much? 1 lakh. And there are 100 shareholders. Are you understanding what I'm saying?
Yeah. Yeah.
Here the interest is $10,000. whether I, whether like whatever I do, I'm going to pay only $10,000. Okay, whether I'm going to do generate more, very high revenues, whether less revenues, whether no revenue, whatever it is, 10,000 is what I'm going to incur. My profit is 90,000. Here, this 1 lakh has to be divided among 100 shareholders, correct? Each one is getting how
Yeah.
much?
100
Each one is getting how much?
$100.
Can I say this is
$100.
EPS, earnings per share?
Yeah.
But here, what is the earnings? The entire 90,000. Why? Because there are no shareholders, correct?
There are no shareholders. Yeah.
And only what cost they incurred is this. Despite of incurring this cost, debt has given them this good advantage of taking the entire profit and not sharing it with anyone. Correct or not?
Yeah.
It is costly. I'm not saying debt is not costly. Debt is costly. Why? Because the cost you can see here. But still it
And
is, still we can take advantage. Okay. So the
hmm.
point here is leverage means taking advantage. Okay. Whether you do activity at high level or low level, the cost is still going to be the same. Okay. So with this note, what we'll do is we'll stop here today. This we'll discuss tomorrow afresh. Okay.
Okay.
Are you following the old videos, Suman?
I couldn't see the last video. I just saw half of it.
Okay. So today, please like wind up that one, and I have
Yeah, I
also
will
shared
do
the
it
profit.
tomorrow morning.
Yeah, and tomorrow I'll finish these topics, and then we can start the profitability questions. We will do in the class itself. Okay. ROA, ROE, all those questions. We'll solve some 10 to 15 questions tomorrow. Fine.
ठीक है, sir.
Okay. Hope
And
I
you'll
was
be helping with the textbooks also, no? Material.
textbook in the sense you want the PDF. You're saying?
Yeah, anything would be fine.
Yeah, I'll be sending the PDF to you.
Okay.
You like I'll try to do one thing. I'll try to see like I can send it on Skype only. So I'll do it right now, right away, within some time. Or else I'll just WhatsApp you. Don't worry, I'll WhatsApp you the material. That's I will take
Oh,
care of that. Okay. So old books I need to give you to
yeah.
other student also. So to both of you, I'm going to send this old books. I've sent you the PDF of profitability ratios. If you find some time, you can try. Otherwise, tomorrow, however, we're going to do some 10 questions. Okay.
So PDF is related to our the sessions which you're giving us, right, sir?
The PDF, Hawk PDF, what I'm going to give you is the textbook, old textbook, which has some questions. The
Okay.
the the clean PDF, what I've shared in the like Skype link, is nothing but the questions. It has all the questions. Okay.
Okay.
Yeah, separate questions to solve. Fine.
Okay.
Okay, I hope I was not fast today. You were able to catch up things.
Yeah, concept level is fine.
Yeah, okay. That means you need to watch the videos once again to
Yes, yes, I do. I do need to watch video once again. And
then you
whenever
will be
I'm
like 100%
trying
sure.
to, yeah. So it's like whenever I see the problem, first of all, I need to understand that particular question and I need to calculate from where I should start. That is the thing I need to work on.
Yeah, yeah. So you today's questions and everything what we discussed again, you should go through that. And any doubts you can bring to my other students. Okay.
ठीक है.
Thank you. Tomorrow, dot one
Okay.
I'll ready.
ठीक है, sir. Thank you.